All right, there we go. All right, and good afternoon, everybody. Welcome to Afternoon Market Action. My name is Patrick France, Senior Instructor here at VectorVest. Unfortunately, my co-host Glenn Tompkins could not be here today, so instead we've got a better visual of him down below me. So, Glenn, if you want to say hello. Awesome. So welcome everybody to Afternoon Market Action. We have the Fed minutes coming out any second now. Should be out now. Came out at 2 o'clock. Right now, what we can see is the market action going on right in front of us here. And we should be live both on YouTube and on Facebook. So good afternoon, everybody. Hopefully you guys are all having a good day. The markets have been up nicely, but that could very easily change in the very near future. So this is our main topic that we're going to be looking at here, focusing on today is, of course, the decision that everybody is really awaiting, and that is the Fed rate hike. So it's frozen. So yeah, welcome everybody. Let's go ahead, dive right into it here today. I wanted to start off with the market timing graph shown since the decision comes out at 2 o'clock and we're going live right at 2 o'clock as well. So the decision should be in. So I wanted to be able to see how the market's reacting once that initial decision comes out. And then we'll go take a look at that decision here in a second. And then we do have the Fed member chat or Powell speaking at 2:30, and we'll make sure we get that up so we can all watch that together, and we'll give our comments and commentary on that as well. So right now, things were looking like we were going to see a little bit of an uptick, but that has been shortly lived. Markets are starting to pull back a little bit. Really not getting too much of a reaction quite yet. We may not see the real movement until 2:30 when we hear Powell speaking, just like we have in the past. So once again, if you guys can hear me out there, let me start seeing some VV Nations in the chat. If everything's coming through fine for you, let me see some VV Nations in the chat going up. Also, if you're new here, if you're just getting started with VectorVest or you're just tuning in for the first time, if you would, just simply hit that thumbs up at the bottom if you're enjoying yourself. All that helps us out, doesn't cost you a thing, and helps continue to support the channel and helps us with the YouTube algorithm. So if you haven't already, go ahead and do so right now. So we should be live both once again on Facebook and on YouTube. Let me make sure we have the YouTube chat working for us. YouTube chat is working. Good morning or good afternoon, Jay. Ramon is tuning in from Houston, Texas. Hopefully it's not as hot there as it is here, but usually Texas is pretty warm. It's been extremely muggy out here today in North Carolina, so hopefully you guys are all staying cool there. Fed raised rates by 0.75 basis points, so 75 basis point hike. Let's go ahead, take a look. I have the updates right here. We'll go ahead and scroll down. Look for the latest updates. Live coverage. All right, so breaking news. Federal Reserve lifts interest rates by 0.75 percentage points, the biggest increase since 1994, and signaling more aggressive rate rise path ahead of us. So 0.75 was the expected so far. Some people were talking about even a full basis point, but looks like we got a 0.75% change here for the day. Let's see. Energy, good morning, good afternoon, VV Nation. Steve tuning in. Hopefully you're doing well. Patrick, I like that name. 0.75 is expected. Brian, Dennis, hello. Hopefully you guys are having a good day. Sherilyn from Southern California. Miss McClintock, glad to have you here as always. Bonjour, Robert. Hopefully you're having a good day here. What's next? So looks like a more aggressive rate hike path is next, but once again, we're really going to be waiting until 2:30 when we have Powell speaking, and that's when we'll probably get more insight to how aggressively they're going to be raising rates going forward here. All right, perfect. So yeah, looks like that decision is in. We do have a few topics here to discuss today as well, but main topic, like I mentioned at the beginning, is going to be the rate hike, which we now have the decision. We're now waiting to hear from Powell to see what exactly their thoughts are on the current situation and maybe gain some insight on their path of how they're going forward with this plan. Also, one of the key things that a lot of people are going to be looking at is the aggressiveness of reducing their balance sheet. So that is one thing that we will definitely be waiting to hear when he talks at about 2:30 this afternoon. Hopefully Glenn is okay. Yeah, Glenn is fine. Just had to take the day off for the day. Excuse me. Yeah, with all the humidity and the heat, it's definitely been a little bit of a hard one on my allergies here the last few days. So I do apologize for that. All right, looking at the markets, let's take a quick look once again how the market's reacting. Right now, the VectorVest composite is continuing to move lower. We saw that slight uptick, but then that was short-lived, pulling us down, getting us close to where we opened up at here at 52.76. We are just a few cents away from the opening or the low of the opening minute here today. So that is definitely a key level of support we want to keep an eye on. So we'll just go ahead, get that put in here so everybody can follow along with us as well. And with that, let's go see how the major indices are reacting as well. So we'll go take a look at the S&P 500 first and foremost, using ETFs or the SPY for the spider, or the spider ETF on the S&P 500. And what we see here is a large increase in selling pressure right at that 2 o'clock minute. We are looking at 5-minute bars. So for this whole entire bar here is representing a total of the 5 minutes from 2 o'clock till 2:05. Now we're seeing the 2:06 to 2:10 bar being formed currently. But what we notice with this candle is, the tall upper wick right at that time frame, which indicates a lot of selling pressure. And then when you look at the volume, that kind of, as we always say, gives conviction behind that move as well. So with that increased volume, that tells us that is the key indicator, the key time, or the key candlestick that we need to pay attention to, because that's really the reactionary candle that we are looking for. So strong volume, tall upper wick indicates most likely we'll continue to see this market taking a little bit of a breather, continuing to sell off as we move forward throughout the rest of the session here today. So glad I locked in my new mortgage rate last night. Yeah, it's going to be interesting to see how long they can keep that up with. Glenn had a meeting with Powell. Hey, you guys all said you wanted Glenn for Fed chair, so that's where he had to go, I guess, here today. Maybe he's keeping that a secret there, Tom. So we'll have to ask him next time we see him here. Let's scroll down a little bit. Glenn would do a 200 basis points. I mean, honestly, I was more hoping for 100 point or 100 basis point move, but the 75 basis points is still better than the 50 that they've been, setting for. But it does honestly admit that they're a little bit behind the bar and that they may be losing a little bit of their grip on the real sense of reality compared to what, their models were projecting. So regardless, I would not want to be in the Fed shoes right now and having to make these decisions and having to change course halfway through it, or just, in the very beginning stages of this interest rate increase that we've been noticing. All right, so getting into it, that's the SPY or this S&P 500. Taking a look at the Nasdaq, same situation. Strong volume first and foremost, telling us this is the candle that's going to be the driving factor going forward until probably at least until 2:30, until we hear Fed Powell speaking. But you have a tall upper wick indicating a lot of selling pressure, and then strong forces to the downside, giving us even more confirmation of that. Now, right now, we continue to move lower, pulling off of those lows, maybe some buying pressure coming in on these lows, maybe some people dipping their toes into sand, but right now I wouldn't read too much into that quite yet here. Then we look at the Dow. Dow, same situation. So a lot of selling pressure coming in right at that 2 o'clock minute. A little bit of buying pressure coming in right now, but looking at the volume, not even, or roughly about half the volume we had from the selling pressure coming in as buying pressure off of these lows currently. What are you talking about? Glenn's pointing to the right, or Glenn's pointing to the right answers here today. So Yeah, and he's doing his best to hold that the whole entire session here today, or the whole entire stream here today. So you got to give him credit being able to hold that pose the whole entire time here today. All right, so yeah, that's what we're seeing with that. Let's go ahead back into the VectorVest Composite. VectorVest Composite not really confirming what we were seeing with the Dow or the Nasdaq, where we were seeing some buying pressure coming in, and now we are continuing to move past. You notice we pierced for a moment the low of the opening here today and tried to hold above it, but looks like we're now pushing back below that low, and that indicates that we could probably be seeing the market trying to fill the gap from yesterday's close to where we opened up at here today. Are you going to be heading into a recession? Me personally, or are we going to be heading into a recession? I think is the better question. We talked last week a little bit about the article that we found showing that U.S. has actually been improving its its trade deficit a little bit over the last quarter by exporting more oil than they were importing. And the real question was, if inflation stays on that downward projection or continues to subside a little bit, then yeah, that could have offset it and given us that negative or that positive GDP for the quarter, therefore potentially on paper avoiding that recession. But with the most recent CPI data last week at 6.8%, it does look like it's going to be a strong feat, or a hard feat to come by to get GDP in positive territory this quarter. So on paper at least, yes, most likely we will be officially entering into that recession very, very soon. So just waiting for the official announcement, I guess, at this point. So with that, let's go ahead, jump in. While we're waiting for that, we see what the market's doing. We've seen the initial reaction. It looks like it's trying to hold the low here, the 52.76 level on the VectorVest Composite. We go take a look at the S&P. Let's go zoom out a little bit. On the S&P 500, where is that? Let's go use our horizontal cursor. We did break below the low of the opening here quite a while ago, so seeing it fading the gap is no surprise. Could have probably used that analysis to help us get a better sense of what was going to happen right out of the gate here with this. Looking at the low of yesterday, looks like we did fill the gap on the S&P 500, so therefore hopefully trying to hold that, trying to get a bounce, but we'll come back to that in a little bit and see. Let's check with our other major indices real fast as well, and then we'll go take a look at some headlines while we wait for the Fed announcement, or the Fed Powell to come out and speak. So let's go zoom out. Dow, we already filled that gap and continuing to move lower. Looking at the Qs, zooming out a little bit. There we go. Qs, we have quite a ways down still to go before we fill that gap like we've seen with the other major indices. So going to be interesting. What's wrong with Glenn? Marcus scared him stiff. So Will, he is holding that pose all day today. It is a challenge. It is the freeze frame challenge is what we're going to call it here. And Glenn is going to hold that pose all day for our stream here today. And he's holding his breath, waiting for what's going to happen with the markets. All right, so that's what's going on with the major indices. We'll come back in a few minutes. Let's go ahead, take a look at a couple of headlines that we had here for today. So to do that, I'll just pull that up real fast. Give me one moment here. And so starting off with our first story comes out from the electric vehicle side of things. And it's a message that that Musk has been giving to as other competitors such as Lucid and Rivian. So in this article, it goes into talk about how, Tesla hasn't always had the easiest times getting their business or getting the company to be where it is today. There's come a lot of struggles that he's had to deal with over the years. And it's basically a warning to these other newer electric vehicle makers to say, hey, you're going to have these hard times, but it comes down to how you can handle it and how you can get your balance sheets on the right track to be able to avoid going into bankruptcy. So it says, in the article, one of the quotes is, his bet even seemed lost when from 2017, 2019, Tesla found itself on the brink of bankruptcy because of difficulties managing its ramp-up production capacity of the Model 3 sedan or its entry-level vehicle there. Talks about a few other times where, he got close to bankruptcy, but luckily was able to make the right moves to avoid that situation. And an interesting part of it that I didn't even realize until I was going through the article today is so far out of all the U.S. manufacturers, U.S. auto manufacturers, Tesla and Ford are the only two U.S. auto manufacturers that haven't ever been in bankruptcy currently. So I thought that was an interesting little tidbit there. Very, very true, Mark. Where's the VIX at this time? We can take a look at the VIX here in a little bit, Lyle. All right. So one of the things that comes down to, really, I want to just mainly get to the meat and potatoes, as Glenn would say, on what we're seeing in the main tips that he has for his competitors with Lucid and Rivian. So coming down into it, the billionaire says that to survive, upstarts must demonstrate that they can overcome the same difficulties as Tesla did. And by doing that, which are among the most promising competitors, are going through difficulties and must join pinned on the future. And then it talks about, once again, as we stated a second ago, Tesla and Ford, the only American car companies that have not gone bankrupt are Tesla and Ford. Thought that point was really, really interesting. And then going through here, and unless something changes significantly with Rivian, so this is what Musk is really worried about. Is their costs and how they're able to avoid this. But right now, he's seeing them, and the way it looks to him is that unless something changes significantly with Rivian and Lucid, they will both go bankrupt. And I hope they're able to do something, but unless they cut their costs dramatically, they're in deep trouble. So just a warning from the competition that, hey, you need to figure out how to make your production more efficient, or else you're going to run into a lot of troubles going forward and could potentially end up back in bankruptcy. And these are already speculative plays to begin with, where they're just in their early infancy stages, and they've had a lot of backing from a lot of major players. But we've also seen in the earnings of Ford, also in the earnings of Amazon, in the case of Rivian, they can that speculation has really been getting hurt, and it's been the main losses they've taken in their most recent earnings announcements. So yeah, big troubles ahead if they can't if they can't start cutting their costs dramatically here. And we'll take a look at their stocks in a little bit. So that's number one. Second article I had for today, and I thought this was interesting, but talking about Lego, just a toy company, but I like the overall mentality or the overall move that we're noticing with it. And Lego is investing over $1 billion in U.S. brick plant, and their main focus here is that they're to help cut or help reduce the supply chain issues that they're experiencing, everywhere is experiencing, and hopefully we start to see this trend really catch on and start to happen with more of the bigger names as well. But to help with the supply chain issues, they're going to put a factory here in the U.S. and that should help, and then start producing here as well, which should help reduce shorten the supply chains and keep up with growing demand for its colored bricks. And one of the biggest markets, obviously, U.S. markets are one of the biggest markets out there. Interestingly enough, one of the other things that they're talking about is the plant will be carbon neutral, which is, nowadays it definitely meets all the right criteria of getting or the catchphrases there, the popular phrases out there, being green. But it also talks about how one of the other things that they're working on is to become less reliant on oil for making their plastic bricks and finding more renewable sources to build their bricks by, so that way they can be a more sustainable company and have a better long-term potential lifespan than what their current models shows sustainable as. So interesting on that one. Did you zoom 3270, but back down now? VIX. Okay, we'll take a look at the VIX here in a few moments. Let's get through some of these real quick, and then we'll take a look at the VIX before Powell speaks today. But yeah, so interesting, change of events here. Starting to see companies announcing plans to build plants here to help reduce that supply chain issue. And once again, it would be nice to see other major companies out there start to adapt this same strategy to help reduce that supply chain issue that they've been experiencing over the last few years. Things. How about cut out including extra parts and things with some Very true, Energy. Very, very true. That could be another great way of doing it. All right. So, nothing, no real stock to look at with this one. Just thought it was interesting that we're noticing a big company, a big recognizable company, making or announcing plans to bring production here to the US, which could definitely be interesting. And then while it's not necessarily the biggest headline here today, it's definitely a headline that's made news, or that's everybody's probably heard over the course of this week so far, at least. And that is Bitcoin and cryptocurrencies in general. Bitcoin continues to tumble, and it broke down below that 21,000. There was a company, MicroStrategy, that's made a lot of headlines as of late, who has been buying up Bitcoin left, right, and center, and they're a big Bitcoin bull, if you will, and they're had a margin call at 21,000. If Bitcoin broke 21,000, that was where they get margin called, and that happened. It dipped a little bit below that point, and so we're gonna take a look at MicroStrategy as well in a little bit and see how their stock is holding up, and see how the Bitcoin or cryptocurrencies in general and crypto adjacent stocks, are holding up currently. So those are some of the headlines that we had here. Getting into it, there's a lot of info in this article, a little bit too much to get through the whole entire thing, but it just talks about how, Bitcoin is continuing to go down, dip below 21,000. I think I saw 20,800, I believe, Energy, if I'm not mistaken, at its low point for the week. And it's interesting, 21,000 was that number that everybody continues to talk about in the community, because that was that margin call territory, and it hit right below that. Almost, it's almost suspicious on how perfectly that hit there. Weeble says low of 20,073. Okay, so yeah, not too far off right there. And then Ethereum as well. Ethereum also taking a big dive, getting close to breaking below that 1K mark. Ethereum, is a little bit different though. Bitcoin is obviously the most commonly talked about one. It's more of that currency representation in the cryptocurrency markets, whereas Ethereum is a little bit different. Personal thoughts, I like Ethereum over Bitcoin because Ethereum is looking at more of the practical uses to build Web 3.0 and build company infrastructure on, to be able to use that blockchain technology to really build out different aspects for major corporations out there that keep them, decentralized, and gives you the whole benefits of that decentralization, and gives you a good platform to continue to grow on there. So while Bitcoin is the flashier one, Ethereum is more of that workhorse. So Ethereum being selling off isn't really the worry or the biggest worry, in my opinion, and actually could create some good buying opportunities in the near future. We'll have to wait and see though on that. All right, so with that, let's go ahead and jump back into the software. There we go. And taking a look real quick at the markets, looking at the VectorVest Composite, back down to the low of the gap up here today, trying to maintain that low right now, trying to hold in tight as a support floor. We'll continue to monitor this here in a little bit. Looking at the S&P 500, moving, tried to see a little bit of an uptick, but now starting to move lower. The Qs, same situation. And then looking at the Dow continuing to move lower. Will we ever go back to the gold standard? Well, there's a few countries that actually are putting more gold backing their currency. So I didn't have anything prepared for that today, so we're not really going to talk about that too much. Maybe we could talk about that next week, though, when Glenn's back, and we could discuss that there. Getting even a primary wave. Yeah. All right, so with that, let's go take a look at the VIX as well. You guys wanted to take a look at that, so we'll pull up the VIX. Whoo! And up and down. So we had a big spike higher here. Where did that spike go? 3260. And then that next bar quickly reverse, moving lower. Volume, obviously, since it's an indice or an index, not going to see that there. But we could use ETFs such as, let's see, UVXY. Let's go take a look at that one. UVXY. Not really moving too much. Yes, we saw the big spike in volume, but price action really hasn't moved too much at that point. So going to be interesting on that one. All right. So with that, let's go ahead and jump into our list that we had here today. Obviously, we'll start off taking a look. This is the current list that I had for today based off some of the headlines that we were looking at. But let's go ahead real quick. Take a look at the picks from last week. Starting off with Glenn's picks. So we had SJT, Tesla, USO, Wheat, and Amazon. Let's see how they've managed so far over the last week. So we'll go ahead and quick test those. And Glenn's picks, down 10.75% here. So SJT down 27%, Tesla down a little over 5, USO down 5, Wheat down just slightly down about 2.7. Amazon being second worst performer, down over 10% here. Let's go see the picks that I had here. Now, don't forget, we'll talk with some of the picks that I had. DHI was a put candidate, first and foremost, for anybody trading options. And then DRV and SRS are both contra ETFs on real estate. So those will go down as real estate, or those will go up as real estate goes down. And then Nugget was my speculative trade there. So let's go ahead and see how those have performed over the last week. Whew. All right, so DHI with a negative 11.83%. So for a put candidate, that would make you money here this week. DRV up 27%, SRS up 17%. So DRV is the triple, SRS is the double. Both of those making money. Nugget we lost out on, but overall, over a 5% gain when you consider DHI was taken as a short trade. So yeah, looks like I had the win for the basket this week. But as always, that could definitely change every single week. And make sure to stick around every week and come back every week as we go through these updates for you guys as well. All right, so that's going to do it for those. Let's go take a look at the new stocks to talk about here. So we had Tesla, Lucid, and Rivian. We'll go ahead, pull those up. I'll just highlight the individual ones and view the stock graphs here. Which were the real estate ones? DRV was the triple contra ETF. SRS was the double contra ETF. And then DHI, if you're trading options on an individual stock, that was my short put or my put option for the week, and that is DHI or DR Horton for the real estate. So I gave 3 different ways of playing the real estate markets, the downside last week, and all those are making money here. Sonny, you saw Glenn move. We're gonna have to keep on him. All right, so let's go ahead and see. Do we have that layout? I don't think. Even after I gave him such a hard time, I don't think he created that layout yet. So let's see. Let's just do this. Actually, we'll do Enhanced Pro Trader Timing. I'll use that as my default. Take off the envelopes. And then add volume. There we go. Price volume. Hey, not a problem, Energy. Glad to have you here today. All right, so looking at Tesla. This is on just today's action. Let's go ahead, zoom out a little bit. We'll do a 3-month look back here. So Tesla has definitely, and I think Glenn and I both agree that Tesla is the clear winner so far and still is the dominant electric vehicle maker in the United States. Therefore, it's also been around a lot longer, and therefore its price is a lot higher than what we've seen with the other ones. But currently, we are seeing, even in the face of an interest rate hike and what's going on here today, Tesla is taking a nice little run to the upside here today. On a positive note, we are currently as well at a higher low for the time being. If we can see if we can see price action take out this high from the 9th of June, then that could confirm these higher lows potentially are leading to higher highs. And by the basic definition, starting to put us on a short-term uptrend. And for anybody who's looking at Tesla, could be a nice entry point. If you've been out of it and waiting for, signs of a move higher here, that could definitely be a nice entry point on that. Also, looking over the last 3 months, this 30-day weighted moving average has acted as a pretty strong level of resistance. It broke out here, didn't stay there for very long, came tumbling back down, and then tried to break out here, failed to do so. So if we can see a sustained price holding above that 30-day weighted moving average, that could definitely be extremely interesting to watch. Let's go see how it holds up, though, with the competition. Lucid, similar situation. It's been moving lower over the last 3 months. I think pretty much everything has been exhibiting this, but similar situation on the short-term time frame for what we were seeing with Tesla. So right now, you're at a potentially higher low. The MACD has been strengthening over the last 3 months, even though price action has been moving lower, setting us up for a potential bullish divergence. And now we want to see the MACD line and the signal line cross above that neutral territory of 0, giving us a new potential long-term uptrend starting to form. Right now, with them both being below that level of 0 and also with the MACD line being below the signal line, gives us a little bit of a negative long or short-term sentiment, but definitely one to keep on your radar and wait to see if we can get that bullish crossover and bullish breakout there. Powell speaking. It is now 2:30. Okay, perfect. So let's go ahead and switch that over. There we go. Go ahead and refresh this. And there we go.
Widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong.
Give me a thumbs
While
up in
labor
the chat if
supply
you guys
remains
can hear
subdued,
this fine and you're
with the labor force participation rate little changed since January. FOMC participants expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024, levels that are noticeably above the March projections. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in April, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core prices rose 4.9%. In May, the 12-month change in the Consumer Price Index came in above expectations at 8.6%, and the change in the core CPI was 6%. Aggregate demand is strong. Supply constraints have been larger and long-lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and food, and is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. FOMC participants have revised up their projections for inflation this year, particularly for total PCE inflation, given developments in food and energy prices. The median projection is 5.2% this year and falls to 2.6% next year and 2.2% in 2024. Participants continue to see risks to inflation as weighted to the upside. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a 0.5 percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
All right. So we can
Thank
see
you. Howard Schneider with
markets
Reuters.
moving higher right now.
Two related questions. Chair Powell, Did you feel you boxed yourself in with the language you used at the last press conference on 50 basis point hikes in June and July? And would you please give us as detailed a sense as you can of what role you played in reshaping market expectations?
So while they're asking the question, real quick, is anybody noticing the body language coming from what we're seeing with Powell? He seems like he is under a lot of pressure and is having a hard time being able to keep a straight face with this. I think, they're realizing, hey, they're a little bit behind the ball with this. Also, the fact that they mentioned taking out energy and food prices during their inflation readings. I mean, you can't take out the two things that everybody needs. Everybody needs electricity. Everybody needs gas to be able to get to their jobs and work. Everybody needs food to eat. He seems like he is sweating really hard trying to get through this conversation here, or this conference here right now. Just initial thoughts. We'll come back to that here in a second.
So that's what we generally think about guidance, and that's why we offer it. And of course, when I offered that guidance at the last meeting, I did say that it was subject to the economy performing about in line with expectations. I also said that if the economy performed, if data came in worse than expected, then we would consider moving even more aggressively. So we got the CPI data and also some data on inflation expectations late last week, and we thought for a while, well, this is the appropriate thing to do. So then the question is, what do you do? And do you wait 6 weeks to do it at the next meeting? And I think the answer is that's not where we are with this. So we decided we needed to go ahead, and so we did. And that's really how we made the decision.
Was that just the nice way of the Fed announcer or Fed admitting that they are way behind the ball on this thing?
Questions. Gina Smilik with the New York Times. I guess I wonder if you could describe for us a little bit how you're deciding how aggressive you need to be. So obviously 75 today. What did 75 achieve that 50 wouldn't have, and why not just go for a full percentage point at some point?
Sure. So if you take a step back, what we're looking for is compelling evidence that inflationary pressures are abating and that inflation is moving back down. And we'd like to see that in the form of a series of declining monthly inflation readings. That's what we're looking for. And by this point, we had actually been expecting to see clear signs of at least inflation flattening out and ideally beginning to decline. We've said that we'd be data dependent, focused on incoming data, highly attentive to inflation risks, the things that I mentioned to Howard moments ago. So contrary to expectations, inflation again surprised to the upside. Some indicators of inflation expectations have risen, and projections of this year have moved up notably. So we thought that strong action was warranted at this meeting, and today we delivered that in the form of a 75 basis point rate hike, as I mentioned. So what was the point of it really is this. We've been moving rates up expeditiously to more normal levels. And over the course of the 7 months since we pivoted and began moving in this direction, we've seen financial conditions tighten, and appropriately so. But the federal funds rate, even after this move, is at 1.6%. So again, the committee is moving rates up expeditiously to more normal levels, and we came to the view that we'd like to do a little more front-end loading on that. So I think that the SEP gives you the levels that people think are appropriate at given points in time. This was really about the speed with which you would get there. So as I mentioned, we 75 basis points today. I said the next meeting could well be about a decision between 50 and 75. That would put us at the end of the July meeting, in that range in that more normal range, and that's a desirable place to be because you begin to have more optionality there about the speed with which you would proceed going forward. Just talking about the SEP for a second, what it really says is that committee participants widely would like to see policy at a modestly restrictive level at the end of this year. And that's 6 months from now. And so much data and so much can happen. So remember how highly uncertain this is. But so that is generally a range of 3 to 3.5%. That's where people are. And that's what they want to see, knowing what they know now and understanding that we need to be we need to show resolve, but also be flexible to incoming data as we see it. If things are better, we don't need to do that much. And if they're not, then we either do that much or possibly even more. But in any case, it will be very data dependent. Then you're looking at next year, and what you're seeing is people see a bit more tightening in a range of maybe 3.5% to 4%. And that's generally what people see as the appropriate path for getting inflation under control and starting back down and then getting back down to 2%. So 75 basis points seem like the right thing to do at this meeting, and that's what we did.
So that
Steve
was a
Leisman,
long-winded
CNBC.
answer
Thank you for taking my
to just
question, Mr.
avoid
Chairman.
the original question of
You
the
have not used
100
the
basis
phrase
point
in a long
move.
time, monetary policy is in a good place, which is a phrase that you used to use often. Now that the committee is projecting 4% or 3.8% next year in terms of the funds rate, which is similar to where the market is now, the futures market of 4% funds rate next year, do you think that's a level that is going to be sufficiently high enough to deal with and bring down the inflation problem? And just as a follow-up, could you break that apart for me? How much of that is restrictive, and how much of that is a normal positive rate that ought to be embedded or not, in your opinion, in the funds rate? Thank you.
Sure. So the
So
question
while he's
really
answering
is,
this, one other thing, is
how
I
high
know
is
we
the rate
do
that
give
we
him a hard
go? And
time,
this is,
but
the estimates
when they
on the
said
committee are
that
in that
rates
range of
or
3.5% to
inflation
4%.
was transitory,
And
that was
how do you think about
before
that? Well, you
all
can
the
think about
energy issues going
the longer
on
run
with
neutral rate. You can compare it
with
to that,
Europe
we
and
think
Russia
that's
and
in the
Ukraine.
mid-twos.
Also,
You can
that was
look,
before
frankly, at
China
broader
started
financial
going back
conditions.
into
You can look at,
lockdowns under zero
asset
COVID
prices.
policy.
You can look at the effect they're having on
And
the
both of
economy,
those, were
rates,
things that
asset
came
prices,
in
credit
after the
spreads,
fact
all of
that
those
have
things
been
go into
really,
that.
as he stated at the
You
very
can
beginning, and
also
I think it
look
was
at
a
the yield
smart
curve and
idea,
ask all along the yield
that has
curve,
been the
where is-
main
where is the policy rate? So for
drivers
much
of
the yield
these
curve
issues that
now,
we're noticing, because right
real
now the
rates are
main drivers
positive.
of inflation
That's
are
not
energy,
true at the short end.
and
At
pretty
the short
soon
end of the
soon to
yield
be
curve
food
in
with
the early
the whole
years,
wheat
you don't
situation in
have
Ukraine
real
as well.
You have negative rates still.
So while
that-
he
I-
wasn't
but
really
that really is one data point. It's
he wasn't
one
really
part of
wrong in his
financial
thinking
conditions.
initially.
So
I think they were late
I
to
have
finally
look at it
admit
this
that,
way.
and I think we're
We
now
move the
seeing him
policy
trying to
rate.
catch
That
back up
affects
as
financial
well.
conditions,
And
and that
his
affects the economy.
his
We
talking
have,
points here.
of course, rigorous ways to think about it, but ultimately it comes down to, do we think financial conditions are in a place where they're having the desired effect on the economy? And that desired effect is, we'd like to see, demand moderating. Demand is very hot still in the economy. We'd like to see the labor market getting better in balance between supply
By the way, the data does not confirm that
and demand.
that people
Right now,
the
there's-
demand is
substantially
still hot in the
higher
labor
than-
or in the
than
markets right
available
now.
Supply, though. So we feel that there's a role for us in moderating demand. Those are the things we can affect with our policy tools. There are many things we can't affect, and those would be the things, the commodity price issues that we're having around the world due to the war in Ukraine and the fallout from that, and also just all of the supply side things that are still pushing upward on inflation. So that's really how I think I would think about it.
But does 3.8%, 4% get it done? Does it get the job done of breaking the back of inflation?
I think it's certainly in the range of plausible numbers. I think we'll know when we get there, really. I mean, honestly, that would be, you would have positive real rates, I think, and inflation coming down by then. I think you'd have positive real rates across the curve. I think that the neutral rate is pretty low these days. So I would think it would, but you know what? We're going to find that out empirically. We're not going to be completely model driven about this. We're going to be looking at this, keeping our eyes open and reacting to incoming data, both on financial conditions and on what's happening in the economy.
Thanks. Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that you like your policy to work through expectations, and now obviously this decision was something quite different from how you and almost all of your colleagues had set those expectations during the intermeeting period. And I know you just said that what changed was really the inflation data, the inflation expectations data, but I'm wondering, on the inflation expectations data, was there something you saw that was unsettling enough to risk eroding the credibility of your verbal guidance by doing something so different from what you had socialized before?
So if you look at we look at a broad range of inflation expectations. So you've got the public, you've got surveys of the public and of experts, and you've also got market-based. And I think if you look across that broad range of data, what you see is that expectations are still in the place, very much in the place, where short-term inflation is going to be high, but comes down sharply over the next couple of years. That's really where inflation expectations are. And also, as you get away from this episode, they get back down close to 2%. And so this is really very important to us that remain the case. And I think if you look for most measures, most of the time, that's what you see. If we even see a couple of indicators that bring that into question, we take that very seriously. We do not take this for granted. We take it very seriously. So the preliminary Michigan reading, it's a preliminary reading. It might be revised. Nonetheless, it was quite eye-catching, and we noticed that. We also noticed that the index of common inflation expectations at the board has moved up after being pretty flat for a long time. So we're watching that, and we're thinking, this is something we need to take seriously. And that is one of the factors, as I mentioned.
So one of the things as
factors
well
in
to
our
keep an eye on is,
deciding when we had
you
was
know,
75
the
basis
change
points.
in
Today was what we
his
saw
rhetoric that
in
he's saying.
inflation expectations. We're absolutely
You know,
determined to keep
beforehand,
them
and when they
anchored
were saying it's
at 2%.
transitory, they were
That
going to
was one of
say
the
they were going to
reasons.
let
The other was just
data
the
really
CPI
drive
reading.
things going forward,
if you saw a
and they weren't
movement
going
like
to be
that again,
reactionary.
another tick
And now
up
he's really
in inflation
changing his narrative
expectations,
to,
would that
hey,
put
we're going
a
to be more
75 or even 100
reactionary
basis point increase in
week by
play,
week, month by
at your
month
next
as
meeting?
new data comes out.
You know, we're going to.
And that could
I'll just say
really
we're going
that
to react
could
to the
be a
incoming
good thing and
data
also a very
and,
bad thing for the markets, because that could mean
appropriately, I
more
think.
surprises
So
coming
I
up from the
wouldn't want to
Fed.
put a number on what
that
might be.
could shock
The main thing
markets
is to
in
get-
ways
to
that
get
they weren't
rates up.
expecting. So
And,
be
and
careful
then
with that language
pretty
that he's
soon
saying
we'll be
now.
in an area where we're, I think, as you get closer to the end of the year, you're in a range where you've got restrictive policy, which is appropriate. 40-year highs in inflation. We think that policy is going to need to be restrictive, and we don't know how restrictive. So I think that's how we'll take it.
Hi, Chair Powell. Neil Irwin from Axios. Thanks for taking our questions. The late-breaking kind of decision to go to 75 basis points, do you worry that will make policy guidance a less effective tool in the future? And should we think of that as a
So
kind of
take a look at the
symmetrical reaction
markets?
function if we start to get soft readings on inflation, or if the labor market starts to roll over?
To take your second question first, yes. I mean, I think we're resolved
Just
to
off of a new
take this
high
on,
here?
but we're going to be flexible in the implementation of it. Sorry, and your question was guidance. So again, the overall exercise is that we try to provide as much clarity about
why
our
off a new
policy
high?
intentions as we can, because we think that makes monetary policy work better. It's always a trade-off, because you have to live with that guidance, and so you do it, and it helps a lot of the time. I frankly think this year has been a demonstration of how well it can work. With us having really just done a very little in the way of raising interest rates, financial conditions have tightened quite significantly through the expectations channel, as we've made it clear what our plans are. So I think that's been a very healthy thing to be happening. So, and I would hope that it's always going to be any guidance that we give is always going to be subject to things working out about as we expect. And in this particular situation, we're looking for something specific, and that is progress on inflation. We want to see progress. We want to see inflation can't go down until it flattens out, and that's what we're looking to see. And if we don't see that, then that's the kind of thing that will cause. Even if we don't see progress for a longer period, that could cause us to react. But we will soon enough. We will be seeing some progress at some point. And we'll react appropriately to that too. But I would like to think, though, that our guidance is still credible, but it's always going to be conditional on what happens. This is an unusual situation to get, some data.
Notice
during
or their
blackout,
guidance to still
pretty
be
close,
credible.
very close to our
I
meeting.
think
Very unusual.
he's
to
realizing
one would
that
actually
the
change
markets
the
are losing
outcome.
faith
So,
in the Fed, and so he has to make sure he hits that
I've
exact
only seen
exact
in my
rhetoric
10
here.
years plus here at the Fed. I've only seen something like that, even close to that, one or two times. So I don't think it's something that'll come up a great deal.
Thank you so much for taking our questions. Colby Smith with the Financial Times. On the clear and convincing threshold for the inflation trajectory, what is the level of realized inflation that meets that criteria? And how is the committee thinking about the potential trade-off of much higher unemployment than even what's forecasted in the SEP if inflation is not moderating, at this acceptable pace?
Sorry, the second part I didn't get.
What's the potential trade-off with higher unemployment than even what's forecasted in the SEP if inflation is not moderating at an acceptable pace?
Right. So what we want to see is a series of declining monthly readings for inflation, and we'd like to see inflation headed down. So,
Well, that's not happening
but,
anytime soon.
And right now our policy rate is well below neutral, right? So, soon enough we'll have our policy rate. Let's assume the world works about like the SEP says. The policy rate will be up where we think it should be, and then the question would be, do you slow down? Does it make you, you'll be making these judgments about, is it appropriate now to slow down from 50 to 25, let's say, or speed up? So that's the
Stock
kind
time,
of
I
thinking
100% agree with you. He's saying that they need to see monthly inflation rates coming down.
We're not going to declare victory
and monthly
until we
inflation rates
see,
won't come down until
a series of
there's
these,
no more
really
zero
convincing
COVID
compelling
policy in
evidence
China,
that
and
inflation
lockdowns are no
is
longer
coming
there.
down. And that's what I mean
and
by that's what
energy
it would
prices
take
or
for us
gas
to
prices
say,
start to
okay,
plummet.
we think this is
because
this job
they
is
get
done.
the supply chain issues
Because
resolved over.
frankly, we saw last year
in
inflation
Eastern
came
Europe.
down
So
over the course of the summer.
yeah,
and
it looks
turned right
like we're
around
going to
and back
be
up.
we're going to be in
So I
high
think we're gonna
inflation
be
times
careful about,
for quite a
about
while,
declaring victory.
unless something
But
drastic
again,
happens in the near
implementation of
future
our
that
policy is gonna
can be
gonna
unexpected.
flexible, and sensitive to incoming data.
Are you more concerned now that to bring down inflation, it's going to require more than just some pain at this point?
So again, I think that I do think that their objective, and this is what's reflected in the SEP, but our objective really is to bring inflation down to 2% while the labor market remains strong. I think that what's becoming more clear is that many factors that we don't control are going to play a very significant role in deciding whether that's possible or not. And there I'm thinking, of course, of commodity prices, the war in Ukraine, supply chain, things like that, where we really can't.
I've been saying this for months
policy
now that
stance doesn't
raising interest rates
those
doesn't
things.
affect the
So-
things that they can't control.
But having said that, there is a path. There's a path for us to get there. It's not getting easier. It's getting more challenging because of these external forces, and that path is to move demand down, and you have a lot of surplus demand in take for example in the labor market. So you have two job vacancies essentially for every person actively seeking a job, and that has led to a real imbalance in wage negotiating. You could get to a place where that ratio was at a more normal level, and you would expect to see those wage pressures move back down to a level where people are still getting healthy wage increases, real wage increases, but at a level that's consistent with 2% inflation. So that's a possibility, and you could say the same thing about some of the product markets where there's just excess capacity, and where the strong demand has gone into where they're capacity constrained, right? So you have effectively what we think of as a vertical supply curve or close to it. So demand comes in and it's very strong, and it shows up in higher prices, not higher quantities, not more cars, because they can't make the cars because they don't have the semiconductors. So in principle, that could work in reverse. When demand comes down, you could see, and it's not guaranteed, but you could see prices coming down more than the typical economic relationships that you see in the textbooks would suggest, because of the unusual situation we're in on the supply side. So there's a pathway there. It is not going to be easy, and again, it's our objective, but
So what he's
as I
just
mentioned,
admitting
it's
is
gonna
something
depend
I
so
made
much
a
more.
reference about last week, and it was started off as a joke, but deflationary time frames or times ahead of us potentially
So the new
going
projections
forward,
show the
because
unemployment rate ticking up
if
through
demand starts
2024.
slowing down
Is a
and that
higher
has an inverse
unemployment rate
effect,
necessary
we
in order
could
to
see
combat
deflationary
inflation?
periods
And what is
and
lost if the
goods and
unemployment
products
rate
and
has to go
services
up
becoming a
and
whole
people
lot
lose their jobs in
cheaper
order to control
because
inflation?
we're basically admitting they overshot a little bit, or
So-
supplies and inventories could
You're right.
potentially be
In the
overshooting a little
SEP,
bit,
we have
trying
unemployment
to
going
pick
up
back
to
up
4.
from,
The median
the
is
depletion they had
4.1%.
from
There are, of course, a
the
range
COVID boom
of actual
out of lockdowns there.
forecasts.
So
And
interesting.
I would
Something to keep
characterize
an eye on
that
as we move
if
forward
you,
here.
If you were to get inflation down to, on its way down to 2%, and the unemployment rate went up to 4.1%, that's still a historically low level. We hadn't seen unemployment rates below 4% until a couple of years ago. We'd seen it for like 1
And
year.
he keeps talking about
in the last
employment
50.
rates and
So
the
idea
unemployment
that,
rate and everybody being able to find a job. One of the things to be careful with, though, is you're seeing more and more headlines out in the news on a weekly basis of companies letting people off. People, especially in mortgage lending, and Coinbase and these other companies that are having a hard time right now. They're firing their staff. So I expect to see that trend starting to change, where you're having a tighter labor market because you're having more people hitting that unemployment number in the near future. So something we'll definitely be watching.
We never
in
think
our
too many people are
AMA
working,
sessions
and fewer
every
people
week.
need to have jobs. But we also think that you really cannot have the kind of labor market we want without price stability. And we have to go back and establish price stability so we can have that kind of labor market. And that's a labor market where where workers are getting wage increases. Maybe the workers at the lower end of the spectrum are getting the biggest wage increases, as they were before the pandemic, where participation is high, where there's lots of job opportunities, where it's just a really...
I'm not sure where he's getting that number from, because wage increases have been stagnant for almost a decade now.
Disparities between various groups at historic lows. We'd love to get back to that place. But to get there, it's not going to happen with the levels of inflation we have. So we have to restore that, and it really is in service in the medium and longer term of the kind of labor market we want and hope to achieve.
And Ms. Harbeck as well. I agree with you. I wasn't stating that.
Hi, Chair Powell, Matthew Bosa.
That's what I've been stating for a while now. Is
as you just mentioned,
Fed's
the committee is now projecting
Fed's trying to raise rates to try to bring inflation down, but inflation isn't caused by that. The inflation is due to supply chain issues and global shutdowns and energy supply issues. That's out of his control. So raising rates doesn't really fix or address or even have any action towards fixing the causes of these current inflationary periods. So I agree. It's not his job to bring gas prices down.
Let's be clear about that. We're trying to
But he
achieve,
needs, if you're going to bring inflation down, you got to have the tools to be able to address specifically the causes to this current inflation.
Clearly, it's our goal to bring about 2% inflation while keeping the labor market strong, right? And that's kind of what the SEP says. That the SEP has inflation getting down to a little above 2% in 2024 with unemployment at 4.1%. So, and this is a strong labor market. This is a good labor market.
Anybody got a time machine they can jump to 2024 real quick and let us know how things are there? Because 2024 sounds like a great time.
That are not under our control. Again, thinking here of the fallout from the war in Ukraine, which has brought a spike in prices of energy, food, fertilizer, industrial chemicals, and also just the supply chains more broadly, which have been larger and longer lasting than anticipated. So the sentence that we deleted said that we believe that appropriate monetary policy effectively alone can bring about the result of 2% inflation with a strong labor market. And so much of it is really not down to monetary policy. It just didn't, the sentence isn't, it kind of says on its face that monetary policy alone can do this. And that just didn't seem appropriate, so we took the sentence out.
Given the new projections for the unemployment rate, could you talk a little bit about what accounts for such reduced confidence against, say, a month ago or 3 months ago that inflation will largely normalize on its own as these supply side issues get worked out? Thanks.
Well, yeah, I think you've seen, again, we've been expecting progress, and we didn't get that. We got sort of the opposite. So I also think the situation really since the consequences of the Ukraine war become more and more clear. What you're seeing is the situation getting more difficult. And you look around the world. I mean, lots of countries are looking at inflation of 10%, and it's largely due to commodities prices. But all over the world, you're seeing these effects. And so, and we're seeing them here. Gas prices, all-time highs and things like that. That's not something we can do something about. So that is really.
But yet
and
they're
by the way,
raising interest rates to try to
headline
fix that
inflation.
issue.
Headline
Doesn't make
inflation
sense.
is important for expectations. The public's expectations. Why would they be distinguishing between core inflation and headline inflation? Core inflation is something we think about because it is a better predictor of future inflation. But headline inflation is what people experience. They don't know what core is. Why would they? They have no reason to. So expectations are very much at risk due to high headline inflation. So it's become, the environment has become more difficult, clearly, in the last 4 or 5 months. And hence the need for the policy actions that we took today, hence our resolution to get rates up and ultimately get them to where we think they need to be in coming months.
Thanks, Chair Powell. Edward Lawrence with Fox Business. I want to ask you, you talked about CPI going to 8.6%. The retail sales surprised the market by falling, and then revisions to the previous months were down. Are you hearing from contacts about consumers slowing spending or changing their habits?
So we're of course watching very, very carefully for that, and looking at the retail sale, the big store numbers and all that kind of thing. And so, but I think the fair summary of what we see is you see continuing shifts in consumption. You see some things sales going down, but overall, spending is very strong. The consumer's in really good shape financially. They're spending. There's no sign of a broader slowdown that I can see in the economy. People are talking about it a lot. Consumer confidence is very low. That's probably related to gas prices, and also just stock prices to some extent for other people. But that's what we're seeing. We're not seeing.
And so,
a broad
JM, to address your
slowdown.
question, so war in a small country screwed up the U.S. economy.
We see the economy slowing
not
a bit,
quite.
but
It's when the
still
aggressor
growth levels,
of that
healthy
small
growth
war is one of the bigger
raising rates
oil
in this
producers
economy, how
out there
closely are
and
you
is
watching
part of the major
consumer
global supply
spending,
chain
or is
for
there,
oil
something another
and for
indicator that you're
producing
watching
oil
more
and getting it
closely?
out to the global markets.
It would be hard
and
to
you
watch
cut that off,
anything much
that
more
will
closely than we
screw
watch
up
consumer
the
spending. But we watch everything.
global markets
we
there.
watch
Not only
business
just the
fixed
U.S.
investment, which
economy,
actually has
but
softened a bit.
European economies and
we
Asian
watch-
markets and
we're
everything.
responsible
So
for watching
it's
everything,
not
but
just the U.S. and it's not just because
consumption
of a
is
small war. It's about
60-some percent of the
the
economy, two-thirds of the economy.
actors
so
in that small
naturally
war
we spend
and
a lot of
what
time on that. And again,
the aggressor
there's a lot
side
going on.
has
There are a lot of
contributed
flows back and
beforehand
forth, but
to the global
ultimately,
economy.
It does appear that the U.S. economy is in a strong position and well positioned to deal with higher interest rates.
Thank you, Mr. Chairman. Michael McKee.
And as you said, the U.S. economy seems to be in a stronger position. I think we showed it last week or the week before. I don't have the links with me on hand. I wish I did, but personal savings are down to before pre-pandemic levels. They're about to go negative. People are running out of money in their savings accounts. They're spending all their money in their savings accounts to try to keep up with the Joneses and keep up with current inflation. That they're burning all their cash reserves, and soon enough, not too far off from current time, we're going to see that playing a huge impact. And this rhetoric of saying the U.S. economy is resilient and strong, they're not going to be able to use that anymore. The data out there, the Fed data, their own data, does not back these comments up, which is making me a little nervous seeing him say this, on live television, knowing that it's not backed up by any actual data, and the data says otherwise.
Really, I mean, the energy prices are set by global commodity prices. And most of food, not all of it, but most food prices are pretty heavily influenced by global commodity prices too, also other things. So we can't really have much of an effect, but we have to be mindful of the potential effect on inflation expectations from headlines. So it's a very difficult situation to be in. And we can't do much about the difference between the elements that make up headline that are not in core.
Could I just, as a follow-up, get a clarification on the SEP? When the members gave their forecasts, when were they inserted into the record? Were they revised after the CPI or Michigan numbers came out? In other words, does the SEP as we have it now reflect the same factors that led you to go to a 75 basis point move?
The SEP is of one piece. It reflects all of the economic readings. It also reflects the 75 basis point increase. This is important. So people had that in hand when their SEPs were submitted. So in other words, it's not in addition to what's in the SEP. The SEP, everyone's SEP reflects their thinking about this rate increase and what's going forward.
So, Kev, to address the question or address your comments there, that is not true at all. If you recall, this is partly both parties to blame. I'm staying neutral, so I will, just like when somebody comes in talking about Biden, I will address the clear elephant and the wrong or incorrectness of that statement when talking about the other side as well, because I'm more of a neutral party on this one. I disagree with both parties. Trump is the one who, was trying to push for more and more money to be printed, which would cause higher inflation. He's also the one when Jerome Powell tried to slow the economy down back in 2018. He's the one who came in and said, hey, you better stop this because my stock market will go down. And that's now made the issue or exacerbated the issue. And
the role
now
that we can play, maybe
part of the reason why we're in these current issues as well. So you can't just blame one side without looking at the other. Both parties are to blame, and both parties
that are associated with
mistakes just to gain popularity are the reasons why Americans are suffering right now with the high inflation and high interest rates and everything that we're experiencing. So can't say one side without the other. They're both equally to blame. They're both one and the same, if you ask me.
So
the only difference between the two different parties, the two major parties, is that they just try to spend taxpayer money in different places. But they both want to spend it as much as they can.
Lead you to go too far.
There's always a risk of going too far or going not far enough. And it's going to be a very difficult judgment to make, or maybe not. Maybe it'll be really clear. But we're quite mindful of the dangers. But I will say the worst mistake we could make would be to fail, which it's not an option. We have to restore price stability. We really do, because everything, it's the bedrock of the economy. If you don't have price stability, the economy is really not going to work the way it's supposed to. It won't work for people. Their wages will be being eaten up. So we want to get the job done. This inflation happened relatively recently. We don't think that it's affecting expectations in any kind of fundamental way. We don't think that we're seeing a wage price spiral. We think that the public generally sees us as very likely to be successful in getting inflation down to 2%, and that's critical. It's absolutely key to the whole thing that we sustain that confidence. So that's how we're thinking about it.
And so, yeah, Mark, I agree with you on that statement, but at the same time,
Brian Chung with Yahoo
presidents have term limits, so eventually it was going to happen.
I just want to expand,
and
I guess,
if we
on
win
what
another
you just
4
said
years
now about the general
of
public feeling
continuing
like,
to let the
you
economy
get
heat
this
up,
done.
and
talk
then all
about
of a
consumer
sudden
sentiment
what
being
we're
down,
seeing now in
household
Ukraine
inflation
happen
expectations being
after
up,
an
recession just
additional
broadly
4
being
more
dinner
years
table talk.
of
Does the general feel
big growth
among American households
it would
and also
just make the
businesses,
situation even
square
worse,
with your
and it would
explanation
be
of
even
the
more
economy,
painful.
given that
Eventually you
description of
have
inflation,
to
the statement didn't change between May and June. Thanks.
Eventually, you have to pay your dues.
Clearly,
nothing is free, and nothing comes for free, or nothing lasts
and many
forever.
people are experiencing it really for the first time, because we haven't had anything like this kind of inflation in 40 years, and it's really something people don't like, and they're experiencing that, and that's showing up in surveys and in all kinds of ways, and we understand that, and we understand the hardship that people are experiencing from high inflation, and we're determined to do what we can to get inflation back down. So that's really what we're saying. Clearly, it's an incredibly unpopular thing, and it's very painful for people. So, I guess what I'm saying is the question, really critical question from the perspective of doing our job, is making sure that the public does have confidence that we have the tools and will use them, and they do work to bring inflation back down over time. It will take some time, we think, to get inflation back down, but we will do that.
All right.
Thank you.
So
Chris
that's
Redeemer,
gonna.
Associated
We'll keep
Press.
it going in the background a little bit, but
talked
let's go
about
ahead and take a
inflation
look at the
few
markets.
times,
Also, if
mentioned
you
oil
guys are enjoying
prices,
this, if you guys are
China
enjoying the
lockdowns.
commentary, make sure, as always, smash that like button, subscribe to the
aside
channel
from
if you're not already
rises in
subscribed,
commodity prices,
so that way,
such as
and
gas
hit on that
prices, we're
notification
also-
bell for
we're
all
also
the
seeing stickier
to
measures
get
of
notified for
inflation
every time we go
increasing, such
live
as the
and all
Cleveland Fed's
the
median
content
and
that we have
trend
coming out
mean
for you guys.
CPIs. How
While we're
persistent do you
listening to this in
see
the
those
background, we'll go
underlying
ahead,
measures of
take a look at the
inflation,
markets. I did see a
and how
question:
do
is the
you
market
expect
gonna
those-
rocket
and where do you
tomorrow
see
or
those going
tank?
in the near future?
Well, let's go take a look
So,
at the markets
as
real
I
quick
mentioned, I
and
think
get
in
an
my opening
idea of what
statement,
happened
the,
last time and
inflation
see,
has
to
started
get
off
a
in
good
quite
expectation
narrow,
of
very
what to
directly,
expect going forward or what we could
pandemic-related,
expect tomorrow.
areas, and it's spread
So if we
now
zoom out, let's go
broadly
6
across
months.
the economy and into the services sector. as
Where
well.
was
It's
it?
really in a
So-
good sector at the beginning. In particular, you're seeing in travel now, if you've flown on a plane
Where do we
lately,
have that?
planes are very full and plane tickets are very expensive. Some of that will be passed through of energy prices, but so you're experiencing services inflation. Shelter inflation is high.
So I believe this was the last time we had. Nope,
So
that
the
wasn't
question,
the last time.
and you see the Cleveland measure going up, and many other measures are going up. So it's a time when we're not seeing.
I believe
progress,
this was the last time
and
we
wanna see
had a
progress,
Fed
and that's
announcement. Was that
really
correct?
Another part of why we did what we did today, and why
I have
the
to go
SEP
back
looks
and
like
look
it
at the
does,
data.
is that we see it as appropriate to get the policy rate up to restrictive levels, which would be, in the thinking of the committee, somewhere in the range of 3 to 3.5% by year end, and then after that, you see what the rest of the SEP says. So I hope that's responsive to your question.
Hi, Chair Powell, Nancy Marshall-Genzer with Marketplace. Do you still think a softish landing is possible, and how would you define that at this point, considering
Looking
the
it up now while
revised
we're listening.
projections for unemployment, GDP, inflation?
So I think what's in the SEP would certainly meet that test. If you see, you're looking at getting back down to almost a 2% inflation by 2024, and the unemployment rate is still as low as 4.1%. That would be, I would call that as meeting that test.
So March 16th.
Do I still think that we can do that? I do. I think there's. I don't want to be the handicapper here. That is our objective. And I do think it's possible. Like I said, though, I think that events of the last few months have raised the degree of difficulty, created great challenges.
So after the
And
last
again,
half
the answer
point
to the
raise
question,
we had on
can
March
still do
16th,
markets
took off a little bit right after
chance
then.
now that it'll depend on factors that we don't control, which is, fluctuations and spikes in commodity prices.
And these lows here
could wind
could
up
be interesting
taking that
'cause
option out of our hands. So we
we
just
go
don't know.
lower,
but we're we're
it's
focused.
going to be a
on
lot more,
very focused on
a lot
getting
bigger of an
inflation
issue
back
than
down
most
to
people
2%,
realize.
which we think is
There's not a
essential,
whole lot more support we have until
for
we
the benefit of
go
the
a
public and
lot
also
lower
to-
than where
to
we
put us
currently
on a
are.
path back to a sustainably strong labor market like the one we had before the pandemic.
So yeah, with what we're currently seeing, these
Greg
big
Robb from
swings,
MarketWatch.
consolidating.
Jeff, I was wondering if you could talk a little bit more. Economists are worried that you're kind of hitting the economy with a sledgehammer, and that now
I think the
there's
best
even
guidance
more
we could
risk of a
possibly give
recession
is
than
what Dr. Delito's preached
than
for
a
time and time
50-50
again, the
path
30-minute
of
rule
rates.
or the,
So could you talk
the
a little bit
rookie
more
hour.
about that, and what evidence would get you to
be patient if you're going to be
stop
looking to
rate
try to
hikes
get
and
into the
maybe
markets
even
tomorrow or take
reverse
advantage one way or the other,
Sure, so
either entering into contra ETFs
as I mentioned, financial
or looking at
conditions
the
have
upside.
tightened,
Be patient. Let the
over the
market
last 7
establish
months,
itself. Give it
and that's
about
a good
30
thing,
minutes
we
to an
think.
hour
But the
after it
federal funds
opens
rate, even after
to
this
let a clear
increase,
directional
is at
bias start to emerge.
1.6%.
And then
So it's
once
hard
we
to
see
see
which
how
way the
that-
major
that
indices
is
are
too
moving
high
at
of
that
a
point,
rate. And even
then
if we
start
did
to
another-
dip your toes
yeah,
in the
we're-
sand
so
one way or the other
we're gonna get
because
here by the end of
we
the
could
summer
see we
somewhere
could
in
make
the
the
twos
case for
probably.
either or.
Still, that's still
and
a
we
low
don't want to
rate.
get caught on the
So
wrong side
that's
of that.
not a rate that is
So I think that
calculated
would
to
be the
bring
best guidance to
a
go forward
recession
with and
on.
approaching
And by
tomorrow
then we'll
with
have seen a
is
whole
be
lot more
patient
data.
and wait 30 minutes to an
As I
hour after
mentioned
the
a
market
couple
opens
times, the
to let
committee's
the
views are
true
around
trend of
a-
the market really
a
establish itself
modestly restrictive
and then
stance, which
let
would
the
be
trend
in
be
the
your
3
friend
to
at that point.
3.5% range by the end of this year. But that's conditioned on that being the appropriate thing to do. If we see data going in a different direction, it'll be reflected in our policy, as you see today.
Market's relatively
we'll
flat
be watching
here.
if things go in a direction we don't expect, then we're going to adapt. And I would say
Same
this
with
is
the Qs.
a highly uncertain environment, extraordinarily uncertain environment. So
Same with the
again,
Dow.
will be determined and resolved, but flexible.
Evan Reiser, Market News
VIX
International.
steadily
Thank you,
dropping.
I was wondering if the Fed has initiated a review of the conduct of monetary policy over the last 2 years or so, given the inflation.
And I appreciate those
will that
comments,
be
Sonny,
shared with
but
the
at the
public?
same time,
And
I
then
would much rather
secondly,
have Glenn
given
here doing it
the
with me.
illiquidity,
It's a lot more
extraordinary
fun when we
volatility
have
in
two
financial
people to talk
markets,
back and
are
forth
you
with.
concerned that QT will make that worse?
Sorry, what was your question on QT?
Just given the illiquidity and extraordinary volatility in financial markets, whether QT will make things worse.
So, of course, we've been looking, very carefully and hard at why inflation picked up so much more than expected last year and why it proved so persistent and resolved but flexible. It's hard to overstate the extent of interest we have in that question, morning, noon, and night. So, but you have to understand the context. Really the context is this: for decades before the pandemic and the reopening, you had a world where inflation was dominated by disinflationary forces such as declining population or aging demographics, let's call it that, globalization enabled by technology, other factors, low productivity. So, and that's how all the models work. Is decades and decades of data. They look at that. It's a very flat Phillips curve work, and the supply shocks tend to be transient, right? So
that's correct, Mary.
We have now experienced an extraordinary series of shocks, if you think about it. The pandemic, the response, the reopening, inflation, followed by the war in Ukraine, followed by shutdowns in China. The war in Ukraine potentially having effects for years here. So we're aware that a different set of forces are driving the economy. We have been, obviously, for quite a while, that these forces are different. Inflation's behaving differently. And in our thinking, it really is a question of very strong demand, but you couldn't get this kind of inflation without a change on the supply side, which is there for anybody to see, which is these blockages and shortages and people dropping out of the labor force and things like that. So that's how we're looking at it. And we've done a lot of work internally on and thinking about what all that means. The thing is, you don't know whether those forces are
3.75 by the end of 2023.
In other words, will we go back to a world where it looks a little more like the old world, or are we really going to be in a world where major supply shocks go on and on? The history is you see these waves of supply shocks, as you did in the 70s, and then they go away, and sort of there's a new normal and things settle down. But honestly, we don't know what that's going to be. In the meantime, we have to find price stability in this new world and maximum employment in this new world where clearly inflationary forces you're seeing them everywhere. Again, if you look around the world at where inflation levels are, it's absolutely extraordinary. It's not just here. In fact, we're sort of in the middle of the pack. Although I think we have of course a different kind of inflation than other people have, and partly because our economy is stronger and more highly recovered. So that's what we're doing. We've done a lot of introspection and work on that. And sorry, on QT, we've communicated really clearly to the markets about what we're going to do there. Markets seem to be okay with it. We're phasing in. Treasury issuance is down quite a lot from where it's been. So I have no reason to think markets are forward-looking and they see this coming. I have no reason to think it will lead to illiquidity and problems. It seems to be kind of understood and accepted at this point.
Thanks. For the last question, we'll go to Mark Hamrick.
Mr. Chairman, Mark Hamrick with Bankrate. Wonder what your assessment is about the outlook for the housing market given the years-long increase in home prices and now the sharp rise in mortgage rates. And all that, of course, given the heightened sensitivity around the housing market, given the fact that it was a trigger for the great financial crisis over a decade ago. Thank you.
Fed fund rates still lower over
rates
time.
Were very low. A good place to start is that rates were very, very low for quite a while.
So
because of the pandemic and the need to do everything we could to support the economy when unemployment was 14% and the true unemployment rate was well higher than that. So, and that that was rates are low, and now they're coming back up to more normal or above levels. So in the meantime, while rates were low and while demand was really high, obviously demand for housing changed from wanting to live in urban areas to some extent to living in single-family homes in the suburbs, famously. And so the demand was just suddenly much higher. And low, so we saw prices moving up very, very strongly for the last couple of years. So that changes now, and rates have moved up. We're well aware that mortgage rates have moved up a lot, and you're seeing a changing housing market. We're watching it to see what will happen. How much will it really affect residential investment? Not really sure. How much will it affect housing prices? Not really sure.
This will be an interesting trend line to follow
obviously
here.
We're watching that quite carefully. You would think over time, so there's a tremendous amount of supply in the housing market of unfinished homes.
We still have a while to go before we get to the 1.2.
Whereas the supply of finished homes, the inventory of finished homes that are for sale is incredibly low, historically low. So that it's still a very tight market. So prices may keep going up for a while, even in a world where rates are up. So it's a complicated situation. We watch it very carefully.
So you just admitted
I would say if you're a home buyer,
interest or inflation has not peaked, and we could still see a higher inflation rate coming in the next coming months.
We need to get back to a place where supply
Buckle
and
up,
demand
everybody.
are back together, and where inflation is down low again, and mortgage rates are low again. So this will be a process whereby we ideally do our work in a way where the housing market settles in a new place and housing availability and credit availability are at appropriate levels. So thank you very much.
All right, so that's going to do it for the Fed. He is officially done taking questions and has had enough of a hard time being able to continue to put this or keep his positive face on. So he is over with. Markets acting a little bit favorable here. Starting to see some higher moves. Still off of their session highs for the day. We'll go ahead and finish off with this, recapping what's going on in the markets. We see the big wild swings that we've noticed ever since that 2 o'clock time frame. Big swings lower, then big swings higher. So markets are moving higher over time, but once again, or at least the overall market, looking at the S&P, big swing lower, big swing higher, still off of its session highs, well off of its session lows. So we're seeing a lot of indecision so far with the S&P 500. Looking at the Qs, same situation. Off of the session's highs, still higher than the lows, still higher for the day overall. Dow, getting close to actually taking out its high for the day, creating almost a new high overall in the market. Appreciate that, stock time. So yeah, Dow is actually looking a little stronger so far than what we were seeing with the S&P 500 and the Nasdaq so far. No surprise, Nasdaq has been one of the worst performers, also been one of the biggest struggles in the market because they have the hardest time being able to continue their debt-fueled growth when interest rates are higher. And then looking at the S&P 500, getting close to taking out that high. So the Dow's number 1 so far, S&P 500 performing number 2, Nasdaq performing number 3, pretty much in line with expectations so far. Looking at the overall markets, trying to climb back, still has a little bit of room to go before we take out those highs here. So I'm going to leave it off on this here today, because we've been together for a while, and I have a feeling Glenn is getting tired below me, holding that face and holding that pose. So we've got to give him a little bit of a break soon, or else I feel like he's going to break. So I'm going to leave everybody off on this note. Once again, the guidance for tomorrow. If you're worried about what's going on, and especially since the data and the announcement is still fresh in everybody's mind, the best way to approach tomorrow is be patient. Let patience be your biggest factor tomorrow. Typically, the guidance we would give, and we're going to stick with that, wait 30 minutes to an hour after the market opens and let the market's trend really establish itself, let a clear trend emerge, and then place your bets from there. So we could see, the market's moving higher right now, but open up down 1,000 points tomorrow. Let the trend really establish itself tomorrow, and then slowly start trickling in that way. I think that's going to be the most appropriate way of playing the markets, and also reducing your risk and giving you the highest probability of success in your trades. So on that note, thank you all for tuning in. Thank you all for hanging out with me today. Everybody give Glenn a big hand for being a great supporting cast here, or castmate here. So thank you, Glenn, for coming out and hanging out with us today. Thank you all for spending your time. Once again, if you're new here, hit that red subscribe button, because if you've enjoyed this content, we have a lot of content coming out to you guys on a weekly basis. So make sure to hit that red subscribe button if you're not already subscribed. Hit that notification bell to turn on the notifications. That way you get notified every time we go live or have new content coming out for you. And if you haven't already, smash that like button. It doesn't cost you anything, and it helps us continue to grow this channel and helps us out with the YouTube algorithms. So as always, until next time, it's been my pleasure being with you guys. Take care, adios, and toodles.